let's get straight into it. What is the ATR?
It is a technical analysis indicator invented by J. Wells Wilder Jr. in a book he wrote in 1978, and it measures market volatility. And it's probably the one indicator that nearly every trader uses. So on the left here, you can see this value. This is the current bar's ATR value, and it's using a 14 bar look back. So over the past 14 bars, whatever I hover my mouse over, that value is giving me the average true range. Each bar individually has its own true range value.
The true range of a candle is taken as the greatest of the following: the current high minus the current low, or the size of the candle itself, or the absolute value of the current high minus the previous close, or the current low minus the previous close. That gives us a candle's true range value, and then an ATR is a moving average of those true range values, which smooths the volatility reading over the recent past.
To get the true range value of a candle in PineScript, we can use the TA.TR value, and to get the averaged true range, we use TA.ATR and a look back. So when you see big spikes like this on the ATR indicator, that means there's been a pickup in volatility, candles are getting bigger, prices are moving much more rapidly or more distance in shorter periods of time relative to the past. So that is the ATR indicator. If you're new to trading, I'm sure your brain is already running with all the different ways you could apply this. And today I'm going to show you several different techniques for applying this. Later on in this video, I'm going to cover a volatility filter indicator I built for this video. So if you're experienced at trading and you know all about the ATR, you might want to skip ahead to this part of the video where we've really applied a creative approach to using the ATR. But if you're newer to trading or coding in PineScript and you want to learn some more basic applications of the ATR, stick through the earlier part of this video because I think you'll find it really interesting.
So first of all, let's have a chat about Keltner channels. I already spoke about that in the previous video, so we'll just do a quick recap.
Now, I'm not going to do a deep dive on this because I did a deep dive on Keltner channels in my previous video. There'll be a link to that below if you want to learn more about this indicator. This is more of a trend following indicator, but it incorporates the ATR into determining its upper and lower bands or channels. If you look at the source code really quick, all this is doing is getting the ATR, which this is how you do it in PineScript, by the way, TA.ATR, and then pass in a look back. The default average standard look back is 14 bars. But you can use any look back you want on shorter time frames on strategies which tend to do things like mean reversion. Usually this would be a much lower look back, but for general use, 14 is typically fine. And what this indicator is doing, this Keltner channel indicator, is it's getting a central EMA and then adding and subtracting the ATR from that moving average to give us volatility bands. Very similar to Bollinger Bands. Bollinger Bands use standard deviation, whereas the ATR is literally distance in price. Go and watch my video on this subject if you are interested in how to use this particular tool and application of the ATR.
So let's talk about using it as a risk management tool or a stop loss and profit target tool. It's a great way for objectively defining our stop loss and take profit based on market volatility. It dynamically adjusts to market volatility. So let's go over that real quick.
The second application of ATR, one of the more common and popular applications, is risk management and profit target calculations. So here I have a really simple strategy script. It's just using the default strategy template from TradingView. If you create a brand new strategy script, this is the strategy that you'll get, a basic moving average cross strategy. All I've done to this script is add a bunch of code to allow us to have a fixed risk reward profile. So what this is doing is whenever a trade is detected, it is calculating a 1 ATR stop loss distance from the entry and a 2 ATR target. Now, the reason why many systems out there, strategies, traders, discretionary traders use ATR as a measuring tool for risk and for profit taking is because of the fact that this adjusts for volatility. As I mentioned, when volatility picks up, this number increases. And what that does is it widens our stop loss and take profit to adjust for recent increases in volatility. And if volatility contracts and markets become less noisy and chaotic, then the ATR will shrink. And if we find like a trade like this, you can see our stop loss and take profit are much closer to price action compared to over here, where volatility was elevated. So that is one major use case for the ATR. Now, I'm not going to go too much into the code here. I've got lessons all over my channel about this, and I also have covered this in exponential detail in my PineScript Mastery course. So go and check that out at pinescriptmastery.com if you want to learn more about the practical applications of some of this stuff. But all we simply do is get the ATR value and multiply it by our stop loss or take profit. So my stop loss distance is the ATR value multiplied by our stop loss multiplier, and the take profit is our stop loss distance multiplied by a risk reward profile. If you want to know more about risk reward profiles and why they are so powerful, go and check out my video called The Math of Winning. Now, we could have like a $10 stop loss on every single trade, and that could be our fixed distance. But then the problem is when this happens and volatility increases significantly, $10 all of a sudden looks pretty small in comparison to price. So don't underestimate the power of the ATR in risk management.
Now let's have a chat about how it can be used as a trailing stop.
So what you're seeing here is exactly the same thing as a fixed risk reward profile. However, it is updating in real time based on price moving into profit. So many traders use trailing stops. All they do is lock in a place to exit the trade as price goes into favor. So in this particular case, if we had entered here with a stop loss here, first of all, probably would have been stopped down on this first candle due to spread. But let's pretend we weren't and we stayed in this trade. You wouldn't be stopped out until here. This is a pretty standard use case for the ATR. So this script I've put together uses the confirm parameter in user inputs so that if I remove this from my chart and zoom out a bit and add it back to my chart, you can see this box down the bottom here that's popped up. Because I've set my parameters to use the confirm equals true flag, TradingView now requires me to select a bar to start plotting from. And so what will happen is when I click on the chart, the start time value will be set to whatever bar I clicked on, and then is active will only be set to true if the current bar is greater than or equal to the bar I clicked on. Once the script is active, it begins trailing a stop loss. So it calculates the new stop by subtracting from the recent candle high. It will subtract an ATR value from it to give me my stop loss. And for short trades, it will add 1 ATR from the recent low. So as price moves down, my stop loss for short trades will move down with price based on the low as the anchor price. And then we have our multiplier here. And the way we make it so that it only locks in the direction of price movements is these functions here, these math functions. So first we calculate a new stop on every single bar. If our trailing stop has not been initialized, then it is set immediately to whatever our new stop is. If it has been initialized and it is not NA, then we use the math.max function to return the greater value. Either the new stop or the existing stop will be higher. Whichever one is higher becomes our new trailing stop, and the opposite for short trades. Very simple, very useful application of the ATR. Again, it will adjust for volatility. So as price volatility increases, our stop loss will widen so that we let price have more breathing room when it needs it. You could also do the opposite and contract a stop loss when volatility picks up. There's obviously a lot of ways to apply this technique. So that's trailing stops. There'll be a link to that script below if you want to play around with it and incorporate it into any of your existing scripts. All you really need to do is change is active to detect if you're in a trade. So if you're using a strategy script to backtest on, you could do strategy.position size not equals 0. That will return true if you're in a long or short trade in the backtester, strategy tester, and then this will update your trailing stop, and then you can use the strategy.exit function to pass in the trailing stop into your exit function like that. I have other lessons on the channel about this sort of thing, so go and check that out if you are interested. For now, I'll leave this template linked below if you want to experiment with it and play around.
Now I want to show you just a simple way you can use the ATR as a candlestick filter to filter out candles that are too small in your candle pattern detection code.
So this script here detects hammer and shooting star candles. So you can see here, this is a hammer candle with a long wick to the downside and a small body in the upper portion of the candle. This is my code for detecting this. I took this from inside my PineScript Mastery course, the Hammers and Shooting Stars lesson. This video breaks down this script in great detail if you want to go and check that out. I've just taken the code from this and thrown it into the editor, and I want to focus on this part here. This is my ATR filter, and what it does is it prevents the script from detecting candles or candle patterns that are tiny, that are extremely small. So sometimes you'll get a candle that looks like this in relation to these bars, and this is too small to be considered a real candle pattern that I want to detect. Now I could easily just add in a check, is it less than 30 cents or whatever in size, but that doesn't automatically dynamically adjust for market types. So on a currency market, 30 cents might be a massive move. And so by using the ATR instead, that normalizes my filter across all markets. And so here I have a 10% ATR filter. The candle size must be greater than or equal to the ATR value multiplied by this, which is 0.1. So if we have a 10 pip or point or dollar ATR, then my candle size must be at least $1 or bigger in size if the ATR were 10. Just for example purposes. If I get rid of this ATR check, just set this to true, and I had to add a BG color on the background here because it was hard to find one, but here's a great example. This is a flat bar. Without my ATR filter, this candlestick pattern could be considered a real pattern. We obviously don't want that. So that is why I use this candle size, which is the high minus the low, must be greater than or equal to my ATR filter. So that's another way to use the ATR, just as a setup filter. Which brings me to another way to use the ATR, which is as a volatility filter.
So one of the really cool features of an ATR is the fact that it dynamically adjusts to market volatility. So it makes a fantastic volatility filter. If you have a system that needs to avoid high volatility, or you just want to be aware of high volatility, it's a fantastic tool for objectively defining what high volatility and low volatility is. So let's have a chat about that. I'll show you a really advanced concept I came up with this week, advanced for me, that I think is really cool. It's a relative volatility filter that dynamically basically ranks current volatility, the current ATR value, against the highest and lowest 20% range over the past 100 bars or whatever the look back is. It's a pretty cool concept. I think you'll like it. Let's get into the code.
I think it's a really cool way to visualize volatility, which is drawing the upper and lower 20th percentile ATR values and clearly displaying when recent volatility exceeds these upper and lower bands. The white line is my current ATR value. If we're above this red line, that is an indication that we have abnormally high volatility. And if it's below this green line, like we have here, then we have abnormally low volatility or volatility contraction. If I drop out to the daily time frame here, it really stands out when market volatility picks up. So you can see the gradient here gets redder the further the ATR gets from our upper 20th percentile, and it peaks around here where the candle sizes are massive in relation to recent volatility. And if you look down here, this blue plot is the ratio of the current ATR relative to the upper band. So if we go over here, you can see that the current ATR reading is 2.2 times the recent upper 20th percentile value of the recent volatility reading, which means we've had really high volatility there. And same with here, you can see that we've had unusually low volatility, which is another word for volatility contraction. What happens after volatility contraction? Eventually, volatility expands and we get increased candle sizes, typically speaking. You can see that we get small volatility contracts quite a bit, and then bam, we get an explosion in volatility. That is not uncommon in markets. So how can we use this as an actual tool? Well, obviously it has its advantages as a visual discretionary analysis, and it's just a great way to visualize when volatility is contracting or expanding. But we can also use this indicator value, this ratio, as a direct input to another script. So if I hide this for now, bring it down here, and we bring up my fixed risk reward strategy again, I've already plugged in some code here. I have this input ATR vola input, which is a source input. It's set to the close by default because it needs a default value, and I can't assign an indicator value by default because we need to select the indicator that we want to use as an input. And so what I have here is, if I scroll down a bit, we have this volatility too high Boolean check. So if this is enabled, which is this setting here, if I tick this box, then my input here, my ATR vola input 1 equal to or above 1, that means that current volatility is equal to or above our red line, this upper band. And if that is the case, then the script will not take any trades. So we've turned our indicator here into a volatility filter. Now, I'm not saying you should use this. It's just an example of how to apply this code. There's no guarantee it will even improve the results of a strategy. In fact, it could hurt the results of some strategies who rely on volatility. Remember, volatility isn't a dirty word. It's not a bad thing. We need volatility in markets to make money, usually. Volatility is where opportunities arise. But there are some strategies out there who could benefit from being defensive during high volatility. And this is one way to objectively define high volatility and use it as a filter or input into a script. So now if I bring up my settings here and we select this input and scroll down to the bottom, here is my ATR volatility script, this thing at the bottom here, and we have ATR ratio is the plot. I need to click that, turn on the filter, and now you can see a bunch of trades disappear from my chart. So if I bring up the settings here and I turn off the filter, you can see the trades come back and the impact of this volatility filter. So when this reading is red, the background of my chart also turns red, and the script is no longer taking any trades. So we should only be getting trades that occur when our volatility is in normal bounds. And I thought that was a really cool way to apply the ATR, especially as a volatility filter. Let's have a quick look at the source code of the script so you can see what's going on under the hood. So I'm just getting the ATR length 14 by default, a window length, which is 100 bars by default, and then the top and bottom percentile, so 80th and bottom 20th percentile. Then we can use the inbuilt TA.percentile nearest rank function to get these upper and lower percentiles. And the 100th percentile is defined to be the largest value in the input data set. So we're just getting the extremes of ATR values over our lookback period, window length, so the past 100 bars, and any bar that falls in those topper or lower 20th percentiles get flagged with this color gradient above and below these bands. And all of this code here looks complicated, but it's literally just the gradient calculation code, visual code. The bulk of the script is right here. So here is where I calculate my ATR ratio, which is what we are plugging into the script up here. And there'll be a link to this script below if you want to play around with the code. And now let's go to the final application of ATR value readings that I want to speak about. It's a really simple application, and that is normalized volatility adjusting. Now it's a fancy jargon for let's get the ATR value, turn it into a percent instead of price-based so that it's normalized for all the different markets out there. Because remember, the ATR value is based on this right-hand scale. The number we get will be relative to the price of the market we are analyzing. And the SPY ETF right now is at $718. Something like the euro dollar is at $1.16. As I said earlier, a candle that is $7 here and is, let's say, 50% of the recent ATR is going to be very different to a $7 move on euro dollar. And that would be the end of the modern world. So how do we change our indicator so that it normalizes readings across all market types? We can do that by converting the ATR into a percentage, which is really easy. We just divide the ATR value by the current market close price. There are other ways you can normalize it. You could use a moving average of price, the same length as the ATR. You could use the high, low, close 3 value. There's a few different ways you could do this. The simplest way to get a normalized reading across all markets is just use the close. And now we're comparing apples to apples. And so what I have here is a momentum screener for the PineScript screener. Now, I've already done a video on this. I don't think this is accessible by everyone out there. This is locked to the higher TradingView plans. It's currently in beta. I'm sure it will come to everyone else eventually. So if you don't have access to this on your TradingView products page under screeners, don't worry, I'm sure it'll come to you eventually. I don't know when, but I'm sure TradingView are working on it. For now, I have access to the beta and I've plugged in my momentum screener. And now what we're doing is I can run this on something like the Russell 1000. So we have 985 stocks on this watch list. If I run a scan, my script, this one here, is now being run across those 900 stocks. We are calculating the composite rate of change, which is in percentage terms. So this is already normalized. ROC just gets the percentage change or rate of change between the current value and its previous value. And then we have these different look back periods. So that's why this is a composite ranking. We're getting the 1 month, 3 month, 6 month, and 12 month rankings, adding them all up while weighting the longer term rankings higher than the shorter term rankings. And then we are dividing that composite rate of change by the market's ATR percent. Now, this is a super simplified application. This is only adjusting rate of change by recent volatility over the past 14 bars. There are more robust ways to adjust rankings for volatility. One great example of that is the book Stocks on the Move by Andreas Klenau. If you haven't read this book, it's definitely required reading for any systematic trader. Go and get it. There'll be a link below. It'll be an affiliate Amazon link, but just Google it. If you don't want to support my channel, just get this book somehow because you need to read it. In this book, Andreas uses the exponential regression, which is, if you're not mathematically talented, like I'm not, it sounds quite complicated, but it's really not. And he does a great job of explaining it in the book. This is probably a better way to adjust relative momentum ranking by volatility, but I just want to show you a really simple concept and method for using the ATR to do a similar thing, just on a much more shorter time horizon. So that about does it for today's video. Hope you found it interesting. If you did, make sure to subscribe and hit the like button, all the YouTuber stuff. And if you want to learn more about PineScript, check out my courses at pinescriptmastery.com. We have over 40 hours of content there, covering everything from the basics to really advanced stuff. And I've also recently launched channel memberships. If you want to support the channel and get videos early and get priority response to comments from me personally, then check that out. It's pretty cheap. And with that said, I'll leave you guys here. I hope you have a great day. Good luck with your trading, and I'll chat with you in the next video. See ya.